Hey, good afternoon, everybody. This is 𝗨h𝗱𝗲𝗿𝘀𝗁 here. I want to thank you all for taking time out of your day. I decided I would at least give you a quick picture, a glimpse into what 160 days of quarantine and not shaving looks like. So I'm going to go ahead and turn off my video, but and we'll get rocking and rolling here. So understanding income options in retirement. Weekly chat with Chris. This is we've been doing this for about 5 months now, and every week trying to bring you topics and information, education as to retirement planning, things that you need to know, both pre-retirement, post-retirement, and just so that in this COVID environment we can stay connected. And so without further ado, I'm going to go ahead and get started. So income planning and retirement, we use a mountain analogy to help people to put into context how we should think about retirement. And the summit is quite often people will think is the goal. So on the way up, we call that the accumulation phase, right? So we're going up the mountain. But then coming down the mountain would be the distribution phase. Once we actually enter into retirement and whatever assets we have amassed, that's what we have to live on for the rest of our lives. Now, one of the points I like to share is that most people don't realize that most of the deaths that have happened on Mount Everest have happened on the way down, right on the backside of the mountain. So with that said, there's some risks that are over there to the right. And I have an acronym, it's called NROOM, and that's short for fear or a risk heading into retirement, which means not running out of money. Then we have another risk, which is called longevity risk. We have our health, we have inflation, sequence of return. I've talked about that in the past. Market volatility, legacy, so the transfer of wealth, and that all encompassing T-word taxes. So those are just some of the risks that we have in retirement. And so when we start to think about our income, whenever we turn off income, we have to now think that whatever assets we've accumulated now have to last us 30, maybe even 40 years, depending on medical advancement. So it's like being on unemployment for 20, 30, or 40 years. So keep that in mind. So key retirement income planning strategies. Dr. Wade Pfau, he was my professor at the American College. He's written quite a few papers. He's become pretty famous now as pretty much the authoritarian on the topic of retirement planning. This breaking of a myth, which is the 4% rule. And basically what was happening is in 1997, a financial planner by the name of Bill Bangden had created a theory that, hey, if you had amassed, let's say $1 million, and that index for inflation, if we could get a growth rate on that money, that we could withdraw 4% out of that account and never run out of money. Well, as I mentioned before, sequence of return risk shows that that is not necessarily true. We don't know what the market's going to do, but in negative years, it can have a serious detrimental effect on the end result. So I put this into graph perspective because this is a chart that I think, tells it all. If you look at that top line, that top blue line, and that's just saying if our portfolio were to get 3% return, and taking that into perspective, and you look on the bottom line, that the 30-year probability, so 30 years, so if you're retired at 65 and make it to 95, even if you got a 3% withdrawal rate, that's the amount of money that you could pull out of your account. You got 3% of your money, you took out 3%, that you would run out of money. You had a 3% probability of running out of money. Okay, so that's what that's saying on the top line. But then if you go down and you say, let's say that, and I was talking to an advisor the other day, and they were showing that this couple was taking out almost 8% a year in withdrawal. And, that obviously would have devastating effect long term. But if you just split the difference, right? If you went to 5 or 6% and you follow that purple line across to 30 years, you'll see you have a 30% probability of not running out of money. Or said another way, that's 70% that you would make it to 95 without running out of money. If you got 5% as your withdrawal rate, right? Now you're at 60% of not running out of money, or 40% that you could. And even with a safe withdrawal rate, which was used to be the gold standard in the industry of 4%, a 15% probability of running out of money. And that's where I used to use the analogy. That's like stepping on a plane in Newark, New Jersey, pre-COVID, and saying, hey, let's fly to San Diego. And if I told you you have a 15% of not making it, how many people would get on that plane? And so when you put things in these perspectives, we have to understand that the distribution through retirement is critically important. This is the numerical data saying the same thing that I just said. Depending on the allocations, whether we go 0% stock, 100% bonds, or in the middle of the page, we have 50% stock, 50% bonds, 4% withdrawal rate, 85% probability of making it, and 15% of not. So that's why when quite often with our strategies, we start to encourage folks to look at bond alternatives and maybe start to think of being a little bit more in equities, right? Just long term, because the bond portfolios can have some risk as well. So this is just more data talking about that, hey, listen, if a couple is married and are both age 62, that they have a chance that one of two of them will make it to age 85 or 95. So it's just talking about statistics here, but let's talk about sources of income. And so I put things in this perspective. I've done a topic here in the past on Social Security, and we're not going to go too deep on that today. I am going to spend a little bit more time on employer-sponsored plans. So if you're in pre-retirement and you're at a point where you can make decisions, things have happened, and maybe a little bit on personal savings. So Social Security, again, it's just today 12% of the total population is 65 and older. But by 2080, so it's a long time off, but basically a quarter of the population is going to be 65 or older. So as a result, the Social Security system is experiencing a declining worker to benefit ratio, and this presents a challenge to policymakers. So let's talk about employer-sponsored retirement plans. There's really two types. There's defined benefit plans, which are pensions, and then there's defined contribution plans, which are things like 401ks, 403bs, or TSPs. So defined benefit plans, you see pension written in the sand. These are, I've said this for a while. If you have one, these are like a unicorn. Very few companies offer these anymore, but they do provide a very specific monthly benefit retirement. The calculation has a predefined formula that usually considers salary and years of service. Most defined benefit plans are covered by the Pension Benefit Guaranteed Corp to help protect workers, and the income is usually taxed as ordinary income. And then the advantages is that the investment decisions are made by the employer. The employer carries the investment risk. The monthly retirement benefit is known, and this could have retirement cash flow decisions, making it easier for the employee. Some defined benefit plans could offer cost of living adjustments, but disadvantages makes tax planning less flexible. You may not cover all of the retirees' cash flow needs in retirement. Some defined benefit plans have complexities that make it difficult for an employee to understand. And then employees do not have their own account, right? So this is always, before you get into the actual payout, this is an asset of the corporation. So these work just like annuities. So, part of what I always suggest is before you make your election on your pension, you should sit down with a professional and talk about what your options are. Are you getting the most value or the best bang for your buck? And, things like single life, right? So this is you're trading the asset. That's what you're really doing. You've accumulated a fund. And this is why when you get your pension statement, they say, hey, you have X amount of dollars, and this will pay you this amount. This is 100% of what you could possibly get. But the downside of that is if you turn around and you do have a spouse, right, that if you turn around and you get a payment or two or three and have a bad day and you end up meeting your maker, that you could forfeit and your spouse would be left without. So that's why they started to offer joint with whatever it is. So it's a reduction of the first full amount, but they offer it based on 2 lives. And then you could get whether 100% of that number or 50% now that one spouse is gone, or we could do it over a specific period of time or a specific life with a period certain. So there's a lot of options with the payout side of this. And this is, again, coming down the mountain. But there's, this is just like an annuity, and that's, the formulas that they use to calculate this. Now we're going to talk about defined contribution plans. And this is, like I said before, 401ks, 403bs, SEPs, simples, all these are tax codes. And they all share the following statistics. The tax deferred retirement savings vehicle. That means that you're saying, I don't want to pay tax today, but I'll pay tax when I take it out. And that is the area that I think most people are following blindly and going down a path that could lead them to get hit by a train. I call it a ticking time bomb. We've talked about quite often the risk of future tax risk. And right now with a country that has an estimated debt of about $24 or $25 trillion, that's unfathomable. But you add COVID to that, and that's $8 trillion on top of that. Taxes, in my opinion, have no choice but to go up in the future. So if we're working and we're deferring taxation into a point in time where we'll be in a higher tax bracket, it doesn't make mathematical sense. But that's how they were sold and designed. And quite often when I'm dealing with people that are pre-retirees or just gotten into retirement, part of what I try and strategize and help them to figure out is to disarm this ticking time bomb, to unravel this tax trap, to figure out what we can do to start to reduce that tax risk into the future. So tax considerations, again, we've talked about it ad nauseum, but when you're talking about taking money and you decide that, hey, we're going to transfer money from one place to another, you always have to pay attention. Make sure you're dealing with a professional, because the tax obligations, they could end up doing withholdings. They could end up saying, hey, you didn't transfer that correctly. There's a lot of minutia and technical rules when moving money from 401ks to IRAs or IRAs to IRAs. So you just have to pay attention to what you're doing. And then, company securities and retirement plans. So quite often, I deal a lot with the pharmaceutical industry, and they will award their employees sometimes with either stock options or stocks. And if you have stocks in a retirement plan, there can be a way to get that money and help reduce the taxes as you carve that out. That's called net unrealized appreciation. And again, it is something in a strategy that should be implemented right at your time of separation, so that you can make sure that you're not getting or paying unnecessary taxes. Because if you move it, roll it all over into an IRA without carving it out, you've missed the boat and you can't undo it. So that was the NUA, and that's the example there. So age 59 and a half, you have the ability to roll over funds from your 401k and do something called an in-service distribution and not pay the tax. You then have the ability to control that asset while you're in retirement. So you roll that into an IRA, and if you have the funds available, you can roll that into a Roth IRA and figure out how to pay the taxes. So you maintain tax deferral, unlimited investment options, ability to further integrate investment strategy with a financial plan. So most withdrawals made from a qualified sponsored retirement plan, but reaching age 59 and a half will come with a 10% penalty if you take it before then. So just be aware of that. Now, there are ways around it, but you got to understand the rules. In most cases, these cannot be undone. Doesn't even matter if it was the advisor's fault. Penalty-free withdrawals before age 59 and a half are available under certain circumstances, but certain conditions must be met. So if you were furloughed, laid off, changing jobs, or retiring, you do have options. You can leave that money behind in the old 401k. But there is a CPA, his name's 𝗥𝗲𝗍𝗏, that has an expression. It's called, you should always roll money away from the 401k plan. So if you can control it, you typically should, to a degree. Again, working with a professional will help you to understand the rules. But the reason for that is because quite often these plans just don't have the choices or options to have an overall comprehensive plan. You can transfer that money to a new employer. So let's say that you change jobs and you go from point A to point B, and that new employer will let you go from 401k to 401k. That is an option. Not necessarily always the best option, but it is an option. You can transfer that money into a traditional IRA. That is quite often your best option, but it doesn't have to be 100%, right? So sometimes leaving some money behind in the old employer's 401k, just in case of emergencies, might make sense. You can receive a lump sum distribution. That is almost always you want to check with your tax professional on. And then you could receive monthly annuity payments if allowed. You could start something out that's called 72T. That has to be structured, and I would be very cautious about exercising that part of the IRS code. And then as you can see, that single life, joint and survivor, and additional choices are usually available. So let's say you decide, hey, listen, I'd like to look at a 401k rollover. I had one of these awful events happen. I was laid off. My company just, COVID right now, got my separation package. Well, as the backbone strategy, many participants decide to move their funds from the employer into an IRA. So once you do that, you basically have three options. You can either do the rollover, right, from a 401k to another 401k. You could do a direct rollover, 401k to an IRA, or you can do a transfer. So if you had an IRA and you moved it into an IRA, but you got to be very careful if you do it that way. Warning, a check payable to you. So if you have this made payable to you, understand it's a mandatory 20% withholding if it's made titled to you. And that will trigger a 1099 form. So, and if you do turn around, so even if you turn around, let's say, for example, you got 100 grand, you're only going to get a check for 80, right? So they hold 20, you got 80, and then if you didn't roll that into an IRA with 60 days, they're going to include all 80 of that $1,000 into your income for that year. So you paid 20 of it, so you paid some of the tax bill, but maybe you're in a higher tax bracket, it could hurt. So if you're going to move money, make sure the check is payable to the custodian. So I use Fidelity, I use TD Ameritrade. So typically how we have the check titled, even though it will go to the home, it's made TD and payable to TD Ameritrade for the benefit of, and that's the plan participant. So if you take a lump sum payment out, right, taxes and penalties are applicable depending on your age. So you will receive the balance, and it is subject to mandatory tax withholding. So if you want a penalty provision from your 401k, you may qualify to take that penalty-free withdrawal if you meet one of the following exceptions. If you become totally disabled, this is what I was talking about. There are circumstances that the IRS will allow you out of your 401k. Another one is if you're in debt for medical expenses that exceed 7.5% of your adjusted gross income. You are required by a court order to give money due to a quadro, a divorced spouse or a child or a dependent, or you're separated from service, and though it's a permanent layoff, termination, quitting, or taking early retirement in the year you turn 55 or later. And that's where you can start to do a direct rollover and not pay the 10% penalty. Taxes are still due, but it's penalty free. And then if you wanted some type of payment structure, that's that Rule 72T. And again, I caution it, that gets a little complex, and I'm not going to go into a rabbit hole in this call today. So personal savings. So you've amassed some money, so now we can pay for our lifestyle in retirement. Either now it's in a traditional IRA or a Roth IRA. The traditional IRA, we can put money into our retirement accounts as long as you have earned income. And right now, those limits for this year and next year are $6,000 per person. And if you're over age 50, you're allowed to do an extra $1,000. Now, the Secure Act eliminates the age restrictions on contributions. So before they cut that off at 70.5, now there's not an age restriction. The Roth IRA, it's the same thing, but we pay tax on the whole amount. We don't get to take it as a deduction, but all the money grows tax-free. Distributions do not cause your Social Security to be taxed. That's why they're so, important, and doing some type of tax planning with a professional is really, really key. Principal is liquid from day one. So if you put money into a Roth and you decide that you want to turn around and you need it, you can pull that out. It's only the gains when you pull those out that are subject to taxes, ordinary income taxes, and 10% penalty. And so in order to avoid that taxes and penalty on the growth, they must be over age 59.5 and then must be in that 5-year look back period. And that's why I try and have people set up Roth IRAs, even if you're not funding them, as soon as possible, so we start that 5-year clock ticking. And then you must meet the income parameters, which the IRS has thresholds for both singles and married couples. So tax efficient income planning. One of the areas that we can look at, I talked about earlier, bond alternatives. So, the word annuity quite often gets thrown around a lot. And I find that most people don't understand what an annuity is. And then there's a lot of opinions out there. And people get confused with nomenclature. If you have an annuity, you see on the left side of the screen it says immediate annuity. That really is the pension option that I talked about before. Basically, you've accumulated a sum of cash. You now trade that asset with the insurance company. You no longer have control of that cash, and they will now offer you a payout structure, whether that be single, joint, or period certain. So that's on the left side of the equation. That's basically a personal pension. Now, on the right side of the equation, you see deferred annuity. And what that allows you to do is to say to the insurance company, I'm going to give you a sum of cash. We would like some upside potential or growth of that. But there could be, depending on the type of annuity that you purchase, there could be some risk. And that's why, a lot of people will say, oh, I don't like annuities, or I hate annuities. Maybe you've heard of that financial advisor, Ken Fisher. You received material from him. Ken Fisher, I hate annuities and you should too. And you see that word variable there? Well, variable, typically when you put the word variable in front of any type of financial product, there's risk. Right? So I don't care if it's a mortgage or life insurance or an annuity, the word variable, typically what I tell folks when I'm offering workshops or teaching classes is I don't want you to walk, I would like you to run, right? So, but the annuities that we do like, and again, these are just tools, right? They're neither good nor bad, but I like a degree of predictability. So now you have the fixed side of the equation. And you have either a fixed, you can have something that operates like a CD where there's a declared interest rate, or you can have something that's indexed, which says, hey, listen, you know what, we can't lose any money in the market, but if we get some gains in the market, we'll capture some of that. So those are all vehicles that I think are good products and should at least be looked at. I just sat with an advisor and his client this week, and it turned out that they had one of these variable annuities. And when I started to go through it with a fine-tooth comb, one of the things that we saw was that it had a prospectus that had 692 pages. Now, when you need 692 pages to explain how much something costs, chances are it's too expensive. Look, if you have some of those variable annuities, or any annuity at all for that matter, you owe it to yourself to get a second opinion. So now life insurance, that's another income option. And I'm going to be doing a call here in a couple of weeks on life insurance, and I'll do a little bit deeper dive. But the different types, this is where it can get confusing, right? Whole life, universal life. Oh, there's that word again, variable. So again, caution, index universal life. And then you have term, right? You have different types of term. So I'm going to do a little bit deeper dive in the future. But, a properly structured cash value life insurance is a very powerful tool, but it has to be built into a larger plan. And then again, these were the early withdrawals using 72T. Those are the distribution methods at the bottom. You have required RMD method, you have a fixed annuitization method, and then you have a fixed amortization method. Again, a little bit too complex that I want to get into today. And I find that most people don't even use it, so I don't want to take up a lot of time exploring this option. But if you have questions, circle back. I'm happy to discuss. So early withdrawals. So the special 401k exception to the 59.5 rule, right? So that was what we were talking about before. If you can do an in-service distribution, you can access your money out of your current employer plan. And again, if you're age 55 and a half, and you've retired or separated from service, you can get that penalty free. RMD, they basically said now, instead of you taking money at 70 and a half, they now delayed that to 72. But if you've started distributions, you may end up having to take 2 distributions that year. Basically, think about it like this. You've acquired and amassed a sum of money, but all of that money is not yours. So if you have $500,000 in a 401k or an IRA, and you're in a 30% tax bracket, you owe the government $150,000. Now, what they say is, listen, as you get older, every year from this point forward that you get towards age 100, we're going to force you to take a little bit more out of your account in order to pay us the taxes that you owe. They're going to force the dissolving of that account. And in a rising tax environment, you could very well, depending on your age, find yourself, 5, 10, 15 years from now, where taxes, I know people don't want to believe this, but let's just, like I said, we're 24, 25 trillion today, add 8 trillion on top of that. So now you're at 32, 33,000 or $33 trillion of debt. And now the government is sitting around, whoever, regardless of which side of the aisle you're on, somebody's going to have to pay the piper. And the only place for the government to go is in these areas, in these accounts where this wealth in America is, and people haven't paid taxes on it yet. So that's why the unraveling of these accounts, while you can, we are actually in a historically low interest rate environment or a tax environment. And I would encourage you to give serious consideration to start to develop a plan to dissolve or disarm your current ticking time bomb. So without that, the last thing I want to talk about is how do RMDs work. If you're going to start to take money out and you have different types of accounts. So let's say that you had $500,000 in your 401k, you could, and you're age 70 or 72 and your RMDs were 18,250, you could do that and you've satisfied it. However, if you had $500,000 in a 2 IRAs, you could split that between the two to satisfy it, or take it from one, right? You could do either or, but if you have a 401k and you have an IRA, you must take it from both accounts. So you have to be careful there. So there's some other little tricky ways to start to dissolve these accounts. If you're charitably inclined, you can do qualified charitable distributions. But before you start giving money away, let's make sure that we're not going to hit end room, not running out of money in retirement. QLACs, which are qualified life annuity contract, right? So there's the ability, if you purchase a qualified long-term care annuity, that they will allow you to keep a certain amount of money in a qualified plan and not pay tax on it. And then they're still working on an exception from the current employer-sponsored retirement plan. So, if you're still working there and you don't own more than 5% of the company and you're at age 70 or 72 and working there, you could actually delay your RMDs from that account. So there's our disclosures. I also want to thank everybody on the call. I want to thank you for joining us. We do these each and every week. If you have any questions for me, there's my email address, chris@professionalplanningservices.com. More than happy to answer any questions. I want to thank everybody. Stay safe out there. If you need anything, reach out and have a great day. Thank you.